Well, good afternoon, everybody, and welcome to the latest edition of the Wednesday Lunchtime Drive-Through on January the 20th, 2021. It is Inauguration Day here in the United States, and my name is Damon King. I'm a certified financial planner professional and wealth management specialist with ChappelWood Financial Services. I'm also the lead instructor for ChappelWood University, the educational branch of ChappelWood Financial. And today's topic is one that is suffice to say, it's one of my more popular topics based on the number of people that are logging on today to the webinar. Potential tax law changes under Joe Biden's presidency. Yes, Joe Biden is now the president. It's President Biden. And so there are quite a few tax proposals that he is pushing that could and will impact you, assuming they get passed. So I want to make sure that if you have a question at any time, please go into the Q&A section of your toolbar. The toolbar is probably down at the bottom. If you hover over it, you'll see it pop up. Just hit the Q&A box and you can type in any question that you want. I don't promise to have all the answers, but I'll give you my opinion if I don't have an answer for you. And so here we go. Let's dive into it. So, who are the primary targets of these proposed changes? Well, we're talking about high income earners, wealthy families that are using sophisticated investment and estate strategies, corporations. The vast majority of Americans, at least according to what President Biden has said, the vast majority of Americans will not be impacted or be impacted very little because these proposed tax changes are impacting or targeting the very wealthy or the very high income earning, okay? Which I find interesting because, you know, there's this there's this thought, this belief, and again, I'm not making a political statement. I never make political statements in my classes. That's for other venues. This is about education. But I do like to look at both sides of any argument. And I like to dissect what's going on here. And there's this narrative out there that, you know, all Republicans want to have as low taxes as possible, and all they care about is helping rich people. And the Democrats are all about taxation and they want to help the little guy. My response to that is, yeah, but aren't there millionaires who are also Democrats? Don't Democrats also raise money from wealthy people? Don't the Democrats also want their taxes to be low too? I don't see too many people raising their hand. Oh, me, I'll pay more taxes. Sure, I'll do it. Come on. I get trying to equalize, if that's the argument. But this narrative that, you know, all Democrats are they're all out there because they're all downtrodden and poor. The hell with that. No, they're not. They have deep pockets just like anybody else. So the point to all this is when these changes are enacted, they're not just going to target Republicans, they're going to target everybody, right? I just find that interesting. That's all. I'm not making a political statement. I just find it interesting. So what is the goal of these proposed tax increases? Well, obviously to raise federal revenue. The plan is to raise up to, if all of these changes were enacted, it would raise an additional $3.3 trillion in tax revenue over the next 10 years. And we've seen record levels of government spending, right? I mean, due to the coronavirus, we saw back last year, President Trump signed into law the CARES Act. So that was, you know, about $3 trillion. Now we're looking at another $2 trillion potentially under Biden. So you're talking about, you know, $6 trillion in government spending to boost up the economy. Now, I'm not going to tell you that it's not needed. It's definitely been needed. If we hadn't done it, then things would be a lot worse than they are right now. But the problem is that eventually those chickens are going to come home to roost, right? I mean, we can't continually spend and spend and spend money that we don't have and not expect there to be some kind of ramifications later on down the road. So as a result, raising taxes would certainly increase government revenue and therefore be able to help cover some of this debt spending that we have. So we have had record levels of government spending. Guess what? The spending is probably not going to stop there. the Biden administration would like to see billions and billions spent on improving our infrastructure. Again, I'm not saying it's not needed, but it's okay, where's that money going to come from? Okay. It's just like you know, if you have to get the roof replaced on your house, it's not like it's not needed. You got to do it, but you got to meet the deductible on your insurance, right? So where's that money going to come from? Okay. It's just, to me, it's simple math. The money's got to come from somewhere. So where's it going to come from? Well, in this case, it could come from more taxes. If all of these things are passed, then what you're looking at is for high income earners, for wealthy people, and generally we're talking about people who have incomes above $400,000 per year, okay? And we'll get into that in a second. Then you're looking at having about 7.7% less income average, all right? For everybody all together, wealthy, middle class, low, poor, you're looking at a reduction of about 1.9% in take-home income, net income for all taxpayers on average. If passed, these proposals are projected to reduce economic growth, or GDP, gross domestic product, by 1.62% over the long term. So if you consider that on an average year, our country's economic growth annually is about 2%. Now this year, it's going to be off the charts. Okay, we're talking probably 4 to 6%. Why? Because the economy is going to open up again once the vaccine really takes hold and we get a better control and handle on the virus. And there's all this pent up demand, right? So we're going to see economic growth unlike we've seen since right after the Great Depression, really World War II. It's going to be off the charts, historic economic growth. But on average, we average about 2% per year. Well, if you cut economic growth by 1.62% with tax increases over time, you do the math, right? So, I mean, it's going to significantly cut our GDP. So now let's dive into what is actually being proposed. Number one, income tax rates. So President Biden is proposing to increase the top income tax rate from 37% to 39.6% for incomes over $400,000. Now, what we do not know at this time is that based on single taxpayer, a joint tax return, or both? We just don't know, because generally if you say, okay, it's 400,000 for a single, well then to account for two incomes, you might see, like 600,000 or whatever for joint income, but we don't know yet. We just don't know. Now, the interesting thing about this increase from 37 to 39.6%, this proposed rate, 39.6%, that's exactly what the top income tax rate was before the Tax Cuts and Jobs Act of 2017. So at the end of 2017, President Trump signed into law, lowered tax rates across the board. Well, 5 out of the 7 tax brackets. They took effect in 2018. It lowered the top rate from 39.6 down to 37. So if this passes, that rate is scheduled to go back to 39.6 in 2026 anyway, because those lower rates are going to sunset, and starting with tax year 2026, they're going to go back up to what they were. So this is less of a rate increase and more of a repeal of the original plan, okay? Instead of going all the way to 2026, for this one tax bracket, it would shorten the duration of that. So far, we haven't heard that he wants to raise it above 39.6, but that's what we're hearing right now. Then we have dividends and long-term capital gains. So I'm not as worried about this one because, quite frankly, this is going to impact, a small percentage of people, okay? Because you have to have an income over $400,000. The one that concerns me the most, well, one of the ones is this one, because whether you make, $400,000 or not, if you have income over $1 million, now granted, $1 million a year is a lot of money, okay? That's a lot of money to earn. But what they want to do is they want to basically abolish the preferential tax rates for dividends and long-term capital gains, which for most people are 15%. But even at the top tax bracket, the most you'll pay for dividends, qualified dividends, and long-term capital gains is 20%. However, for people with incomes over $1 million. And again, we don't know, is that a single filer or a joint filer? Then what he basically wants to do is say, okay, for you guys, dividends and long-term capital gains are just going to be taxed at whatever your ordinary income tax rate is. Okay. So then you add on top of that, so the 39.6 plus you have to add in the 3.8% net investment income tax, or the NIT. And this is an additional surcharge on capital gains and investment income, really, for people above certain income thresholds. Well, you add that 3.8%, and so you get 43.4%. So that's what high income earning households would pay on their dividends and long-term capital gains. This would be, well, not catastrophic, but this would be a huge blow to high income earning households who derive most of their income from dividends and long-term capital gains. You know who would be really pissed off about this? Warren Buffett. Warren Buffett doesn't take a paycheck. He doesn't. You know how he gets most of his income? From dividends and long-term capital gains. So even at his top tax rate, 20% plus the 3.8% net investment income tax, his top tax rate is 23.8%. That's way below 43.4, right? So that would be huge for really high income earning households. So if you expect your income to be of above $1 million, you might consider harvesting gains and dividends right now before any laws are changed, so that perhaps they'll be grandfathered. Because here's the deal. Even if the tax laws are changed this year, based on everything that is on the president's plate as well as Congress's plate, it's highly unlikely, and past tax law changes have proven this out. It's very unlikely that they would be retroactive back to the beginning of this year. Okay, more than likely, if they're retroactive, they might go back a couple months, but more than likely they're going to say, okay, if we pass this year, it'll start January 1 of next year, something like that. But something to think about. Something else. Here's another major change that is being proposed. They're proposing to cap itemized deductions at a flat 28%, meaning that your deductions that you take, so when you itemize, first of all, most people don't even itemize anymore. They take the standard deduction. So you can either take the standard deduction or you can itemize your deductions, and you use whichever one is higher to lower your tax bill the most, right? And some of the common itemized deductions are mortgage interest, charitable gifts, property taxes. Of course, those are capped at $10,000 already. And there are several other itemized deductions. The trouble is that if you're in the 35% tax bracket, well, then a deduction is going to be worth more to you at that tax bracket because you're paying a higher tax, right? So since our tax code is progressive, meaning that the tax burden gets progressively more the more income you earn, well, then a deduction is going to be worth more to you because you pay more tax. But if we cap the value of deductions across the board at a flat 28%, that's going to help somebody who is in a lower tax bracket because they don't pay as much tax, but it's going to hurt someone who is in a higher tax bracket because now a deduction is not going to go as far. It's not going to save you as many dollars. All right. So the net result is high income earners would see their taxes rise relatively. Okay, they would pay a higher portion of their income in taxes. So what can you do? Well, if you are one of those that actually still itemizes on your tax return, if this were to happen, you may want to front load your charitable gifts early in 2021 to lock those in before there are any changes. Now, you're not going to change what you pay on your property taxes. You're not going to change what you pay on interest. I mean, if you accelerate payments, you're actually going to pay less interest, right? So you're going to pay the interest you're going to pay. So the one that you can really try to change and manipulate is your charitable giving. So if you usually give at the end of the year, you might want to give at the beginning of the year. Now, again, keep in mind, we don't know when or even if any of these changes are going to happen this year. We just don't know. But it's good to be prepared and really pay attention to it. And of course, we're going to pay attention to it and continue to let you know. And again, if you have any questions about anything or any comments, please share them down in the Q&A box in your toolbox. 401k contributions. Now, I was on a call with a client last week, and I was asked the question, I heard that Joe Biden is coming after my 401k. He wants to charge me extra taxes on my 401k, or he's going to make me withdraw, something like that. That's not exactly what's happening. Okay, so the proposal that Joe Biden has made is with the deductibility of 401k contributions. So kind of going back to the itemized deductions, all right? When you contribute money directly out of your taxable income into a 401k, what does it do? It reduces your taxable income, all right? To the point that if you earn $100,000 and you contribute $20,000, let's keep the math simple, that basically reduces dollar for dollar your taxable income from 100,000 down to 80,000. Okay. What that does on your taxes, though, is that depending on your tax rate, the higher your tax rate, the more valuable that reduction is to you, right? However, what the proposed Biden administration wants to do is create a flat deduction for 401k contributions at 20.5% for everybody, rather than based on your current tax rate. So the lower your tax rate is, the less valuable in terms of dollars the deduction is. But the higher your tax rate, the more valuable it is, because you're able to save and set aside deferred taxes on a higher percentage of your income. If it's at a flat tax rate of 20.5% or the deduction rate, then what that's going to mean is it's going to hurt higher income earners more. Now, the myth is this is not a tax on your 401k, okay? They're not going to target 401ks and assign a new tax to it. It is an equalization of the deduction, which has the net impact of increasing the amount of tax dollars over time that wealthier families will pay. So, what's probably going to happen here? Well, if you're a wealthy person and your income is above $400,000, because that's kind of what the tax, or something like that, then instead of deferring the taxes now, since they're not going to be as valuable to you, you're probably going to make and say, you know what, if my company allows it, I'm just going to contribute to the Roth 401k. If they're going to take my deduction away right now, well, the hell with it. I'm going to pay the taxes now, so that way I have tax-free income later on in retirement, because it's going to be tax-free. It's not going to be subject to required minimum distributions, because you're probably going to roll it out and you'll put it in an IRA. And at that point, if you keep it in your 401k, even Roth distributions, even Roths are subject to RMDs. But if you roll it over into your IRA, Roth IRA, which most people do when they retire, it's not subject to RMDs. That would actually decrease the amount of tax revenue to the government over time, because the government depends on those people taking RMDs in retirement. So that's probably what wealthy people would do, and that's what I would encourage my clients to do, okay? Because my job is to help you save as much on taxes as possible. Social Security. What are the changes to Social Security? Well, the primary change here is as it relates to the payroll tax that you pay. So when you get your paycheck, part of your taxes are payroll taxes, right? And you pay a tax that goes to fund Social Security. You pay a tax that funds Medicare. The tax that funds Social Security, not 100% of your income is taxed for Social Security. There is a cap. For 2021, that cap is, we will tax the first $142,800 you earn for Social Security purposes. Anything you earn beyond that, we're not going to tax it for Social Security. Now, 100% of your income, regardless of how much you earn, is taxed for Medicare purposes. What Joe Biden is proposing is that we're going to have two levels. First of all, everybody will be taxed on the first $142,800. Then there's no tax. But once your income gets above $400,000, now we're going to tax all that as well, all the way up. So if you earn $1 million a year, let's say you earn $500,000, okay? Your first $142,800 would be taxed. Then there's going to be a donut hole, a gap. Then that 100,000 you earn above 400 would also be taxed. So higher income earners may start to find other ways to take their income that are not considered wages or salary. For example, maybe you're a self-employed person, and instead of paying yourself a salary, and it really depends on how your business is structured, but maybe you pay yourself dividends instead. And if the dividend thing happens, you'd much rather pay that than possibly have more of your income tax for Social Security. I don't know. I'd have to weigh the numbers. Okay. There may be some people who are like, hey, instead of cash, I'll take some other kind of bonus. I don't know. But all I know is that when the tax code taketh away in one area, it usually giveth in another. Our job is to find where it giveth, since it taketh also. So that would be kind of an interesting one. The reason, obviously, that they want to do this is because Social Security has a solvency problem. All right. 1031 exchanges. So there's a proposal to eliminate this strategy for people who earn an income above $400,000. What this strategy allows you to do, so section 1031 of the tax code says this. Let's say you have a piece of real estate, investment real estate, not your primary residence, but investment real estate. If you go out and sell it, it's appreciated in value. You're going to sell it and you're going to have a taxable capital gain, right? Then you're going to take whatever's left over, and then you want to go out and buy another property of equal or greater value. So you have less money to spend because you had to pay some of it in taxes. A 1031 allows you to exchange one property for one of greater or equal or greater value. And you can use that one to trade up. You roll over your basis, or it has an adjusted basis, but the key is you do not have to pay the capital gains tax yet. You can trade your way up the ladder, and you only recognize the taxable capital gain when you finally sell the property, whatever it is, for cash. President Biden wants to eliminate this rule, this strategy for those who earn an income above $400,000. So again, if you're someone who is earning a high income and you have a piece of rental property or investment property that you might want to trade, you may consider executing a 1031 exchange early in 2021 so that you can get it in before the rules might possibly change. Okay. Estate taxes. Now, the vast majority, under current law, the vast majority of estates in the United States are not subject to estate taxes. In fact, right now, less than half of 1% of all estates in the United States are subject to estate taxes. That is because the unified gift and estate tax threshold is $11.7 million. This means that you could die today, and so long as the sum total of lifetime gifts you've made and your remaining estate, everything you own, is less than $11.7 million, you're not going to pay estate taxes. Married couples can unify theirs together. So let's say you are a surviving spouse and your spouse passes away this year. All right. If they did not use up all of their lifetime amount, because it's 11.7 million per person. So whoever the surviving spouse is in a married couple can use their own 11.7 plus any unused portion of the deceased spouse, meaning that you could have an estate valued at 33.4, or what is it, $33.4 million. Wait, is that right? $23.4 million. I'm just a financial advisor. I can't be expected to do math. You can die with a lot of money. But what they want to do is lower that threshold down to 5 million. Now that's going to capture a lot more people in the estate tax net. He also wants to increase the current estate tax rate from 40% to, we don't know what, 50, 55, I don't know. He also wants to eliminate the step-up rule that helps to lower capital gains tax on inherited assets. So right now, let's say you inherit a house from somebody, a parent, whatever. Your parent, your mom and dad paid $50,000 for it years ago, but now the house is appreciated to $150,000. If they were to sell it as an investment, or if you were to go out and sell it ordinarily, you'd have a $100,000 taxable gain, right? But the step-up rule says the new basis, when you inherit it, your basis, what you would have paid for it, is equal to what the value of the asset was on the day of death. And if it was 150,000, your basis is now 150,000. If you turn around and go sell it immediately for 150 or not much more, then your capital gain is either zero or very small. But he wants to eliminate the step-up rule so that we can capture more capital gains when people sell assets. Now, these changes are probably going to be a long-term play. There are a lot more things on their plate than this. However, it's still a good idea to consider estate tax reduction strategies. Maybe you shift an asset that you own, maybe you shift it to somebody else who's in a lower tax bracket, get it out of your estate. Or if you want to leave life insurance to somebody, set it up instead of in your trust, set it up in an irrevocable trust. So instead of using a revocable trust, because those assets are considered part of your taxable estate, if you set it up in an irrevocable trust, that's no longer in your estate. You don't own it anymore. So those are some strategies to think about as well. Corporate taxes. Here's another big one. And this one would impact everybody because the current corporate tax rate is 21%. It was 35%, but then in 2018, the new tax rules dropped it from 35 to 21. Huge boom to the economy in 2018. The market was down, but the economy was way up. Why? Because companies didn't have to pay so much in taxes. Their profits were up. They got wealthier. Biden wants to increase the corporate tax rate back up, not all the way to 35, but he does want to increase it to 28%. So corporate profits would go down. You'd probably see companies pay out lower dividends. You'd probably see jobs lost because they don't have as much money to hire and keep hiring people. An increase in the corporate taxes would almost certainly cause the market to experience a correction, probably in the range of minus 10 to 20% in the short term. Now, eventually the market would stabilize and it would have its new set point. But if we saw a shock to the system like that, I can almost guarantee you the market is going to not like it. All right. So if we see corporate taxes, for all of you who are our clients, know that we are paying attention to the corporate tax rate. And we've already been speaking with a lot of our strategists that if that looks like it's going to happen, we need to possibly consider some changes in our portfolios. Maybe we move more to bonds or something else, but we would need to make some changes most likely. All right. Now, I have just a couple of minutes here left. I pride myself on starting on time and ending on time. Now, that's all well and good, right? That's what they're proposing. But there are a lot of reasons why we will not see taxes increase in 2021. So I want to share some of those with you. Number one, tax law takes time to write. It takes even longer to pass. Okay? And people say, yeah, but now we have a unified government. The Democrats control all three phases of government. Well, I guess the Supreme Court is a phase of government. It's a Republican majority in the Supreme Court. But in terms of the presidency and Congress, they've got all three, right? Well, the Republicans had all three. Remember, the Republicans had all three when Trump was first elected. And they had all three for most of 2018 or most of 2017 until the midterm elections. And then the House flipped in favor of the Democrats. But before that happened, they were able to get the Tax Cuts and Jobs Act passed through. But it took a whole year. It took a whole year. And that was with a much larger majority than the Democrats currently have. The other reason, the economy is still recovering from COVID-19. Okay? It would be very stupid, very foolish. Let me use that word. Stupid may be too disrespectful. It would be foolish to raise taxes in the year that we know the economy is most primed to recover or begin recovering. That would not be a good way to start the first year of your presidency, to have an economic and market crash just when things are starting to get better, right? Higher taxes would work against employment. So, one of the key hallmarks and calling cards of Democrats is we want to put everybody to work. Okay, jobs for everybody. Well, higher taxes would almost certainly hurt that. The other reason why, and I just alluded to it, that to me, it's a long shot that taxes will change this year, is because the majority that the Democrats have in the House and the Senate, they're very, very slim. I mean, their majority in the Senate is one, and that one is Vice President Kamala Harris as the tie-breaking vote, meaning that it wouldn't take a lot for one or two Democrats on either side to kind of go over and say, no, 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 I don't want to do this yet. All right. As I said, raising taxes would almost certainly disrupt the economic recovery that is certain to begin in 2021 if we just leave things alone. And I just don't see the president or Congress wanting to disrupt that while so many people are struggling and just recovering. We do have a comment here. Yeah, Ellen says, amen to that. We need a recovery first. You're exactly right, Ellen. We all need a recovery. And to me, it just doesn't make any fiscal sense. I mean, if you want to get reelected, which I think all politicians do at some point, having a really great opportunity to knock it out of the park your first year financially, it would be stupid to me, again, I'll use that word, if they raise taxes. Now, it's more likely that we're going to see taxes raised in 2022 if that were to happen. So, any questions? Any questions? If you've got to jump off, I understand because we are up at 1 o'clock here, but are there any questions? Maybe you just have some comments or thoughts about any of this right now. Thank you, Ellen, for your comment on that. Any questions? Now's the time. While you're thinking of your question, I do want to let you know, if you're ready to register for another one of our free virtual events, I have to tell you about the Diva and Friends Virtual Speakers Series. So this year, we are going to have a series of guest speakers. Now, last year we had Charles Payne of Fox Business, and he was in the fall. Coming up on February the 17th, that's a Wednesday from 3:30 to 5, we're going to have George Ross, and he is known as Donald Trump's coach. He's been Donald Trump's coach for the last 4 decades, but he's also really well known as one of the guest stars of The Apprentice. And so we're going to have George Ross on. George has been involved in some of the biggest real estate deals in Manhattan. And he has coached, and he still coaches people all across the world on business, motivation, how to be a better leader, that sort of thing. So he's going to come on and join us. Of course, we're going to talk about what's going on with the market and the economy. So if you want to get enrolled in this, it's free to enroll. All you got to do is go to ChappelWood.com. And what it's going to look like when you go to ChappelWood.com, I want to show you exactly what you're going to see. And let's see here, share. So when you go to ChappelWood.com, so see that right there, you're going to see this giant big thing right here, okay? And you're going to click that. And when you click it, it's going to take you to this page, and you're going to sign up for the Zoom meeting. And all you got to do is put your name, your email address, and then you're going to answer a few questions here, and then that's it. It doesn't take anything else to register. So we'd love to have you in our Diva and Friends. We have a comment here. Kathy says, thank you, Damon. First one I've attended, really enjoyed your slides and thoughtfulness of this topic. Kathy, you're very welcome, and we want to welcome you as one of the newest members of the ChappelWood family. And this is the kind of education and information that you should get used to. This is the kind of stuff we talk about. So we're always going to stay on top of these things, and we're looking forward to working with you and your family. And the last thing that I want to show you, so I have one other thing to show you, and then I'll let you go, I promise. So sign up for the George Ross event on February the 17th. And if you still haven't had enough and you want to attend my full-blown class, my Rock Your Retirement class, the one for January is starting tomorrow, so I've already got everybody in that one, so that one's closed. Of course, if you send me a message right now and say, hey, Damon, I want to get in the class January 21st and 28th, what do I got to do? Send me a message, email me, damon@chappelwood.com. I'll make sure you get in the class. But if you can't, February 18th and 25th is the next class. So go to ChappelWoodU.com. Now that site looks like this here. I'll just show it to you one more time. That site looks like this. Okay, so when you go to ChappelWoodU.com, you'll see ChappelWood University, and you can get enrolled in our class. I guess technically you can still enroll in January. So you can get enrolled in tonight or tomorrow night, or if you want to wait till February, you can do that too. So anyway, I want to thank you so much for being on the Wednesday lunchtime drive-through today. I hope that you got a lot out of this. Look, we don't know what's going to happen with taxes. but it's very important that we stay on top of everything and that we continue to stay connected to our money. Nobody cares about our money more than we do, right? So you got to stay on top of it. So I don't see any other questions. So thank you again for being on today. Hope you have a great rest of your day, and take care. We'll see you soon. Bye-bye.